I have been trading the opening range breakout strategy for a few months now, and it's worked pretty well, but today I'm going to share a small tweak that makes it even more profitable. This is a morning breakout strategy. So I'm on the 15-minute chart, and I look for the 9:30 candle that marks the New York opening times. So that means that in my TradingView chart, I need to make sure that the time zone is set correctly to New York. Once I found the 9:30 candle, which in this case is this candle down here, let me just move this box out of the way. I then use the high and the low of that candle to define my opening range. So I take the high over here and the low down here. So that is the opening range for the day, and I'm going to be waiting for breakouts outside of that range. So if I bring this box over here again, this is effectively just the range marked into the future. I then wait for a 15-minute candle to break outside and close above the range. So in this case, the break happens on this third candle of the day, and it breaks through, but then it also closes above. If this second candle here, for example, had wicked up above, but then came down and closed down here, that would not be a trade. I needed to actually close outside of the range. So that gives me the confirmation to enter, and I immediately open a trade on the next candle. So at the open of the next candle, I've gone long. The stop loss then goes at the bottom of the range down here, and I aim for 1.5 to 1 take profit ratio. And that system works pretty well most of the time. Now, like I said, the opening range is defined by the 9:30 candle. And there are days when this candle is either really big or really small and indecisive. And that can cause a problem because I use the bottom of the range as my stop loss down here. So if the range is really big, then the stop loss is going to be quite big as well. And the take profit as a result is going to be even further away. On the flip side, if the range is really tiny, then there's just more chance of being quickly stopped out, even if the trade goes the right way in the end. What I need to do is define a minimum and a maximum acceptable range. And for that, I'm going to use the average true range, the ATR indicator. This indicator measures recent volatility, and it will adapt accordingly based on what the price is actually doing. By default, this is set to a value of 14 for the length, meaning that it looks at the last 14 candles, but that isn't much use on a 15-minute chart, especially because a lot of those candles are going to be in the pre-market and overnight session. So I changed this to 1,344. The way I get that is that there are 4 15-minute candles in 1 hour, and there are 24 hours in a day, and then I multiply by another 14 to give me a 14-day look back. That gives a much more smooth version of the ATR. So what I can do now is once that 9:30 candle closes, I have a look at what the ATR is at that time. So here the ATR is displayed in the top left corner, and at this point it is 10.7. And I can use this ATR to give me minimum and maximum sizes that the opening range can be. So if the ATR on this 9:30 candle is 10.7, then I can test out different multiples of that to give me the maximum and the minimum size for this opening range. So I started with the maximum. I wanted to see how big an opening range is still acceptable and profitable. And this is what I got here. So this chart shows the maximum size of the range using the ATR multiples, and the multiples are along the x-axis. So over on the left is 7 times ATR as the maximum acceptable range, which is pretty huge. Most of the trades are going to fall within that range. Over on the other side, I've got 1.5 times ATR. So that's going to filter quite a lot of opening ranges out, because they're going to be bigger than 1.5 times ATR. The green line is the annual return. The red line is the drawdown. As I restrict the maximum size that the opening range can be, my return drops down. But looking further at the data, the reason for this initial dip is not reduced profitability. It's just that there are fewer trades. So naturally, as I'm filtering out more and more trades, there's going to be a lot more setups that I'm not taking. So there are fewer trades as this goes along the x-axis. The win rate, however, stays around the same until somewhere around here, which is when things drop off pretty quickly. So restricting the opening range too tightly affects the results pretty significantly. But now on the drawdown side, I end up with this kind of cup shape where there's a gradual improvement in the drawdown, but as my opening range gets smaller and smaller, the drawdown creeps back up. So it looks like the happy medium is somewhere around here. And I think a value of 3 times the ATR for my maximum opening range size seems to give me the best results. So back on my chart, this 930 candle has an ATR of 10.7. 3 times that is 32.1. So all I need to do is measure the size of this candle, and it is 21.2. So this candle would be okay, and it would be within the limits to be traded. But if I have a look at this trade here, the 930 candle has an ATR of 8.5. That times 3 is 25.5. So if I measure this range, it is 26.5, almost 27. So then I wouldn't take this trade. That gave me the maximum limits, but I also needed to know how small the range can be. So I did the same test here. I've got ATR multiples on the x-axis. This time they're increasing from 0.5 up to 2.5 times ATR. So for a trade to be taken, the opening range has to be bigger than these multiples. When I initially tighten up the range, going from 0.5 up to about 1.25, the results actually improved. So missing out a lot of the smaller ranges made the strategy better. However, restricting it too much quickly damaged the performance. The drawdown stayed pretty steady throughout, so that didn't actually change a whole lot. But it does seem like if I aim for 1.25 as the smallest range acceptable, and I skip out all the trades that have a smaller range than that, but I allow all of the trades that are bigger than that up to my maximum limit, then I get the best balance of annual return and drawdown. So I reran my backtest, and this was the updated equity curve, which shows pretty solid results, starting with an account balance of 100 back in 2020, growing up to about 1200 today. And these are the side-by-side metrics comparing the original strategy with this updated strategy where I set a minimum and a maximum size for the acceptable range. The final balance improved a little bit. The annual return also improved very slightly. So it looks very similar to before, which might seem a bit confusing based on the charts I just showed. But the reason for that is the number of trades. So I went from 765 in the original strategy to 483 because a lot of the poorer setups were filtered out. So in fact, this return was achieved with fewer trades, meaning that the profit per trade went up. And you can actually see that reflected in the win rate, which is now up to 50.8%. But the other important improvement is the drawdown. It was at almost 28%, which is tolerable for a 5-year backtest, but now it's dropped down to 15.2%. So it protects the capital a lot better by filtering out those weaker setups. So I'm really happy with how this small tweak improved the results. Let me know in the comments how you trade the opening range breakout, and if you have any other suggestions that I should test out.